Everybody, it's Jeff McGinnis at CrossCountry Mortgage. I'm super excited to be delivering the Rate Watch report for the month of September. So this is going to be a look back of what happened in August. We're going to talk about our basics. We're going to talk about inflation and Fed funds and what's happening in the bond market. I do want to do some myth busting about Fed funds, just as a good reminder. We'll again look at the charts, see what happened, and we'll talk about rate trends. And then I want you to be aware of what to pay attention to as we go through time and space so that you can be up to speed on what you should be looking at. So Fed funds, inflation, jobs, the charts. I'll talk a little bit, we'll riff a little bit, have some fun with it, and then we'll go from there. All right, let's get after it. So I want to make sure that everybody is aware of what Fed funds, and when they talk about the Fed is raising rates, what does that mean to mortgage rates, mortgage loans? Well, what it doesn't mean is that when the Fed raises rates, that doesn't mean that they're raising 30-year fixed rate mortgages. I want you to be really crystal clear on that. What the Fed does is use the Fed funds rates to control the temperature of the economy. And right now, the Fed feels that inflation is too high, there's too many jobs out there, and it's too hot for the economy's health. We can't have too many dollars chasing too few goods because that's inflation. So what do? They make things more expensive for the financial sector. So they could raise Fed funds. And so what they're trying to do is cool off the economy so it doesn't get into a crazy hyperinflation situation. So when you hear Fed is raising rates or there's a rate hike, it doesn't mean that rates on 30-year fixed rate mortgages are going up. As a matter of fact, it's probably good for 30-year fixed rate mortgages, which is totally counterintuitive. Now, as we get to the charts, we'll see that isn't really necessarily the case, but they are not directly related. I want to be crystal clear on that, okay? Next thing I want to talk about is inflation. I'm going to show you some charts. So I'm going to get that chart up and then we'll take a look. Okay, team, here is what I wanted to share with you about inflation. So this is the consumer price index chart I just Googled it. And here, what I want to show you is not necessarily the minutia of these numbers, but the trend of what's happening with these numbers. So CPI, or Consumer Price Index, is a good indicator of where we are heading with inflation. And I want to show you this. So June of 22, August of 22, we were heated, right? Inflation was pretty hefty. And the Fed started doing their Fed hikes, and you can see every month it's been coming down and down and down and down and down and down and down. So I want you to know that what the Fed is doing is, with the Fed hikes, is trying to get inflation down, right? So they're trying to get inflation lower so that things don't get out of hand and too expensive. So what they're doing is actually effective. Now, when I go to the bond charts, you'll see that it wasn't a great month for 30-year fixed rate mortgages, but it just takes time. And I'll get into a little bit of the why we had a bit of a rougher month last month and what we could potentially expect given our history, what we know about inflation, what we know about jobs, and that sort of thing. So I'll pull that up here momentarily. Okay. Bond charts up and running. Look at my charts. Look at my charts. So what we're doing is showing you the mortgage-backed securities market. It is the opposite of what you think. So as this market goes down, then rates come up. As it goes up, rates come down. So red, bad, green, good, as a refresher. Now let's take a look at the month of August. So I don't know, we kind of came out again about where we ended, but we had this big trough here from the 10th of August till the 1st of September of this recording date. And you can see rates went up and people got really freaked out and stopped, like they ran to the hills and they didn't want to buy houses because rates were higher. I want to talk about that as in a little bit, but we're back basically where we started at the end of July, by and large. I mean, we had a bump and then it came back, and now the trend is pretty well the same as it was when we started the month. Okay, so I'm going to stop that share. So let's talk about what that means to the opportunities that exist in the real estate market. So when rates go up, people get afraid, and when people get afraid, they don't do anything. They either fight, flight, or freeze, right? Those are the three things they do. And by and large, people will freeze and do nothing. Now, what does that mean for the brave and the ready? It means that because we have such a low inventory, it means that there's some opportunities to come out as a buyer and get a good price without a lot of competition. So when I'm talking with my buyers, I'm talking about this great opportunity because eventually this window will shut, right? We're seeing inflation. You can see it in the inflation chart. Inflation is coming down. The job market is getting softer, which is why we had higher rates last month, because of some of the jobs reports that were a little bit more robust than what we had anticipated or hoped for, and the market responds according to that. That is an inflationary concern. When there's a lot of jobs out there, then that means people are spending money. When there's not a lot of jobs out there, that means they're maybe holding back a little bit more. So circling back, if rates are a little bit more elevated and we have low inventory, it's a great opportunity for buyers that are brave and they're ready, because that means you can get a good price. So how do we tolerate the higher interest rates? Well, we do have some opportunities with different products. One of them is a strategy with a buy down. I won't get into that in this video, but rest assured, there's some great ways to manage cash flow and take advantage of this particular open window. So that is, that's what we covered. We talked about Fed funds and did some myth busting there. We talked about inflation and how we can see it's coming down through the Fed hikes. We talked about the bond market, and it was kind of a net zero event for last month. And then we see some opportunities for buyers as well. I did want to just also underscore the jobs markets. We're seeing the unemployment rate come up a little bit, or the employment rate is it's coming to right size. A full economy is actually 5% unemployment, and I haven't looked. Actually, let me pause out. I'll look at a chart and see what our unemployment rate is. Hang tight. Okay, I'm back. I found a chart that we could take a look at. So as I mentioned before, a full economy is considered by most economists to be about 5%. At least that's what I was taught. We are definitely below that at 3.8 in August. And so, but you can see the sawtoothing. It's not moving a lot, right? It seems to be sawtoothing ideally in the right direction, but very, very slowly. What these numbers, though, won't tell you are some of the strategies that companies are digging into these days. And I'm not sure if I'm using the right terminology, so forgive me if I'm not, but they call it not quiet quitting, but quiet cutting, I think is what the name du jour is. But basically what companies are considering is handing people lower titles, more workload, and what they're doing is decreasing their expenditures by paying people less and loading them up with more duties. That being said, I don't claim to be an HR specialist or anything like that. I'm not accusing any companies of doing anything that wouldn't be proper or legal, but it is happening from what I understand at some major companies. And what that does is it doesn't affect our unemployment rate, but what it does is effectively handle a lot of our inflationary concerns, but the Fed's not going to be paying attention to that, right? They're not going to dig that deep. So my concern is that the Fed is going to stay too long to the party with these Fed hikes and maybe overshoot their goals and maybe look back in the mirror and go, maybe we should have stopped that a little bit sooner. We'll see. I don't know. I mean, I feel like they came late to the party. Maybe they're going to stay a little late. Jerome, kept saying that inflation was transitory when it clearly wasn't. We needed to take a little bit of action a little bit sooner. But anyway, we're on the right path. Inflation's coming down. Our unemployment rate, it's not great for people. I get that, team. I'm not like cheering on, yay, fire people. I'm not saying that, but I am saying that in a healthy economy, right around 5% unemployment is a full economy. So that being said, I'm here to help you. If you happen to be one of my referral partners, I'm here to help your people understand these concepts so that they can become brave and ready, because luck favors the prepared and wealth will be created in real estate this year. And I want you to be a part of that. And I would love to help you. Feel free to reach out to me. My information is somewhere around here, either in the information page on YouTube, or perhaps DM me if we're on meeting here on Facebook or LinkedIn, whatever works. Google me. I'm Googleable, but make sure you put mortgage in your Google search, because otherwise you'll find the NBA star, Jeff McGinnis, and I don't play basketball. I'm not good at it at all. But anyway, have a great one. I'll see you next month. Talk with you later. Take care.